Vivek Nair, Vice Chairman and Managing Director of the Leela Group, joins us right now on the show to talk about that. Good having you. Thanks so much for joining in. Now, just tell us, I mean, as the holiday season kicks in, which accounts for, I think, over 60% of your business, if I'm not wrong, are you hiking tariffs, and what is the quantum for the same?
Well, I can speak of the industry as a whole, as I'm the current president of the Federation of Hotel and Restaurant Association of India, which represents more than 3,400 hotels and restaurants in the country. The peak winter period, yes, accounts for about 60-65% of the total earnings of hotels in the country, especially those which cater to foreign travelers. But then every year you have the hotels revising its tariff on 1st October onwards. And because of the fact that the downturn in the economies, both in Europe as well as the US, have not brought the levels of foreign tourists to India as we experienced in 2006 to 2009, our rates have been quite competitive in the past, and therefore I don't think hotels would be wishing to increase their rates very markedly, except to cover the increase in because of inflation and the higher energy costs and the higher payroll costs. So it would not be right to say that the hotels would be increasing the rates just to take advantage of the holiday season. And as far as the business hotels go, you would know that between December 15th and January 10th, the business hotels do not have any visits of foreign visitors because they go home for Christmas. It's only the leisure resorts in Goa, Kerala, and other parts of the country which have increased demand for rooms.
Right. So, Vivek, I mean, what kind of occupancy levels do you expect? As traditionally, it's a busy quarter till March.
As I said, the quarter 3 and quarter 4 are the peak periods. And in business hotels, depending upon the location, we would expect the industry to do about 70% between October and March. That's because, as I mentioned, for 5 weeks during the Christmas New Year period, occupancies are low because of the foreign business travelers not coming to India at that time. But the resorts in Goa, Kerala, Rajasthan, and other places are much sought after, and I would think that occupancies would be around 75%. And during the Christmas New Year, during those peak 2 or 3 weeks, it could be close to 90% or not, if not higher.
Have talks with Reliance Industries or RIL materialized on the news of them acquiring your IT park in Chennai for, I think, 170 odd crore rupees? And what revenue generation does this bring to the company?
The sale of the IT park was part of our initiative to reduce our debt, and it was part of the non-core assets which would bring down the debt by about 750 crores. So it's towards that initiative that it has always been proposed to be hied off, and the sale is in accordance with that objective.
Right. So, Vivek, I mean, what is the update on plans to sell your land parcel in Hyderabad, where you had planned to build a luxury hotel, and have you made any headway on plans to develop land parcels in Pune for residential purposes as well?
Yes, both our joint development in Pune as well as in Bangalore are making good progress. We are planning to have upmarket residences there, and the portion of the revenues which come to us will be in accordance with what we are given to our financial institutions and banks, and that includes Hyderabad also. So the 750 crores which we envisaged would be met through the sale of non-core assets.
Okay, the high finance costs ate into your Q2 bottom line figure. Where do you see profits and sales stabilizing?
Now, with the commissioning of our Chennai hotel, you'll have the income of Chennai, added to our top line. But of course, the depreciation of Chennai will also increase to overall depreciation costs. Our efforts to with Udaipur and Goa being qualifying now for infrastructure lending in list because they are located in cities of outside city limits of 10 lakhs, we'd be able to replace our high cost interest loans by either ECBs, which the government allows based on your past 3 years foreign exchange requirement, or long-term loans. ECBs, of course, will be a much lower rate of interest, so that will reduce the interest burden